Hello, I'm Kim Stafford, and I'm here again with PIMCO Group CIO Dan Ivascyn to give you an inside look at some of the recent discussions taking place within PIMCO's Investment Committee, or IC. Thank you for joining us, Dan.
Thanks, Kim.
The bond market in 2025 has had its best performance in years, and this has happened even without a major rally in rates. What have been the key drivers of this strong returns, and what is the opportunity that we see in fixed income going forward?
Sure, you're right. It's been an exciting year, a great year from a performance perspective, and there have been a lot of areas of the market that have worked in terms of generating return, maintaining liquidity, maintaining investment flexibility as well. But really, it's been the starting yield being so attractive that's driven a good portion of those returns. There's been also a lot of relative value opportunities just across yield curves as well. The front end of the yield curve, shorter maturities have outperformed longer maturities. The United Kingdom, even the long end of the Japanese market, Australia, a very high quality bond market, all provide very attractive yields when you hedge back to the US dollar. So these have been great diversifiers, reducing portfolio volatility and also generating attractive returns. And then even the currency, the dollar itself has weakened a little bit this year. Another key theme of ours, very small dollar underweight, expressing relative views across some of the more liquid, higher quality currencies across the globe have provided some incremental return. And then last but not least, what we call the spread sectors or the credit sectors have been quite target rich as well. So high yield, lower quality credit has performed well, consistent with the elevated equity returns. But you've also been able to generate very attractive returns for our clients in higher quality, more resilient areas of the market. A lot of diversified sources of return using all the tools of the toolkit. So excited about the year. More importantly, excited about the prospects for future returns as well, with yields still elevated, offering attractive opportunities and lots of less correlated cycles around the globe, allowing us again to generate attractive returns, versus passive alternatives that are out there.
Private credit has been a hot topic for clients. There's been some concern in the wake of the recent bankruptcies involving companies who are accessing these markets. Does PIMCO have concerns about private lending? How are we thinking about private markets and really credit more generally, given where we are in the credit cycle?
Yeah, so short answer is some concerns, but it's not about private credit versus public credit. I think the right way to look at credit from an investor's perspective is across the liquidity spectrum. Am I getting paid to take less liquidity? And then across the credit or the economic sensitivity spectrum. The more economic sensitivity I have, the lower quality that particular form of credit risk, the more spread compensation that we as investors want to get. And I think what's important to note is that we've had many, many years of very strong credit performance. We have very tight spreads. We've had a lot of growth in some of the more economically sensitive areas of the credit markets. And that's true of bank loans, which are considered more public in nature, or private credit, mid-market direct lending as an example, which is considered more private. So given the expansion we've seen in these markets, given some of the deterioration in underwriting, it shouldn't be a surprise that we're having a few credit problems. We do think that some of these areas of the market that have grown too quickly are going to disappoint investors. What's great as an active investor, and I use the term investor as opposed to deployer, sometimes it feels like people are simply deploying the money that's coming in from investors. This is very exciting. It allows us to make relative credit decisions, focus on areas that are more resilient in nature. And when you do have that economic slowdown, people will see the difference between resilient and less resilient profiles. So I think our mindset at PIMCO is let's maintain liquidity, which means future portfolio flexibility.
Many clients are growing cautious on what's a maturing bull market in equities. Stock valuations are near all-time highs, and it seems like there's a near endless expenditure on AI in the market. How should clients think about the opportunity and the risk in balancing those things in today's financial markets?
If you look at the starting valuation for equities today, the starting valuation for high-quality fixed income, you compare those relative valuations over multiple decades of history, on a forward basis, bonds are expected to do quite well. Absolute, relative to equities, relative to their lower anticipated volatility, and relative to cash. So, whatever mix you had, for much of the last 10 to 15 year period between stocks, bonds, cash, other instruments, you probably want to shift a little bit of money away from these sectors that have served you well, but are stretched from a valuation perspective. I think the same mindset holds, though, within equity markets. You have significant dispersion, significant differentiation across sectors from a valuation perspective. So there's a lot of attractive active decisions that can be made within that space. But I think just the bottom line starting valuation is one where investors should be more cautious. But as an insurance policy of sorts, we do think it makes sense to diversify a little bit into fixed income. I think the same is true, and perhaps I even have a stronger level of conviction, as it relates to cash, because the cash rate with near certainty is heading lower, at least lower over the near term. And it's the first time in a long time where that cash rate is heading to a level meaningfully below the yield you can get in an intermediate duration, high-quality bond portfolio.
Great. Well, thanks very much, Dan. And thanks to all of you for joining us. We'll see you next time.